Hello everyone, and welcome back to another episode of Simply Wall Street's Market Insights. I hope you're well and that you had a fantastic weekend. This week, we're diving into the opportunities and risks in the small cap universe. Over the past few weeks, we had a look at the healthcare sector, which has underperformed over the last 2 years. Another underperforming group of stocks has been small cap stocks. Over longer periods, small caps have actually outperformed the wider market, and they often do well as bull markets mature. So this week, we're looking at the data on small cap performance over various periods and some of the traps to avoid when looking for investment opportunities in this space. Before we dive into what happened in markets this week though, here's our quote of the week. I'd buy small caps if starting over now. I think if you're working with a small amount of money with exactly the same background that Charlie and I have, and the same ideas, same ability we have, I think you can make very significant sums. But as soon as you start getting the money up into the millions, many millions, the curve on expectable results falls off dramatically. Warren Buffett. Now, let's dive in. What happened in markets this week? Here's a quick summary of what's been going on. Firstly, Spotify tests Gen AI voiceover ads. TechCrunch. What's our take on this? The company is launching an in-house creative agency to help brands create marketing campaigns. The agency is developing a tool that advertisers can use to create scripts and voiceovers using generative AI. It will be an interesting test to see how well the company can monetize an AI tool and whether it attracts new advertisers to the platform. The podcast ad business is also a key growth opportunity for Spotify. Check out some investor narratives on Spotify by looking at their company report. Next, lithium price finds stability with new pricing floor. S&P Global. What's our take on this news? It's well known that the slowing EV market, combined with more lithium supply steadily coming online, drove the price of lithium down 79% from $66,000 per tonne in February 2023 to $13,800 per tonne in late May this year. The new down cycle left producers trying to protect their margins and the lithium price itself, i.e. by cutting production, which created a new price floor. Forecasts by commodity analysts expect lithium to be in an oversupply until 2028. But that doesn't mean we can't see price appreciation in the near term if demand rebounds or if supply continues to be constrained. Next up, Fisker files for bankruptcy. Barron's. What's our take on this news? Fisker has become the latest casualty of the slowing EV market. One of the differences between EV companies and most tech growth companies is the capital required to keep an automaker going. Fisker burnt through nearly $900 million in 2023 and would have needed a lot more to get break even, assuming it even could. When EV sales were rising each year, raising fresh capital might have been possible, but investors aren't willing to bet on startups in an industry with no growth and falling margins. Next up, Adobe sued for subscriptions that are too hard to cancel. The Verge. What's our take on this news? The impact on Adobe's churn from this lawsuit remains to be seen. If the company is forced to make cancelling a subscription easier, it might finally enable a portion of currently subscribed users to leave the service, which, of course, could decrease users and revenues. Alternatively, an easier cancellation process may entice non-existing users to subscribe for at least a short period of time for their needs rather than not at all, which could increase users and therefore revenue, like we see on some of the streaming platforms. Regardless of what happens, to reduce churn, SaaS companies should aim to provide more value in their subscription than what they're charging. And of course, just don't do rent-seeking. Everyone hates that. Next up, OpenAI could become a for-profit company. Neowin. What's our take on this news? This would give the company a B Corp certification and legally require it to consider its impact on society and the environment, while balancing the interests of its shareholders with those of employees, customers, the community, and the environment. Going down this path would allow it to IPO at some point, which many investors would probably find enticing given the current hype around it. And lastly, China home prices fall the most in 10 years. Reuters. What's our take on this news? Despite the latest round of stimulus measures, China's property market remains in a slump. There was also bad news in other sectors, as industrial output and fixed asset investment were lower than forecast. The one bright spot came in the form of better than expected retail sales figures. China is now more dependent than ever on exports, where it's also facing headwinds in the form of a growing list of tariffs. Global investors can be thankful that their exposure to China's local economy is limited. Now, let's dive into the main piece. How to invest in small caps without losing your shirt. If you hear about a stock that doubled in a week or read an article about the next 10-bagger, that you absolutely have to own, of course, chances are it's a small cap. It's less often that you hear about the ones that didn't work out. For every big winner, there are plenty of losers, but those big wins do plenty of heavy lifting, as small cap indexes have actually outperformed over large cap indexes over longer periods of time. For example, since 2000, the MSCI World Small Cap Index has risen 646%, nearly twice the MSCI World's index at 335%. The catch is that nearly all the outperformance occurred during the first 10 years. Small cap outperformance wasn't unique to the 2000 to 2010 period. Over most periods prior to 2010, they outperformed large caps. More recently, low interest rates and the pace of tech innovation have favored large companies. It's entirely possible smaller companies outperform again in the future, particularly after lagging for such a long period. But there are a few caveats, and investors need to be able to avoid the lemons at the bottom of the market value table. So let's talk about small caps and very small caps. The small cap universe includes companies with a market value of up to $2 billion, but it also includes very small companies, even those with a market value of $100,000. There's a big difference between companies on either end of that range. The MSCI World Small Cap Index, shown above, includes 4,100 companies with a market value between $20 million and $22 billion, probably overdue for a rebalance. The average size is 1.8 billion and the median value is 1.1 billion. So there are some very small companies in the index, but they don't have much of an impact on its performance. Very small listed companies, i.e. microcaps, nanocaps, and penny stocks, have much less reliable performance. The following table will give you an idea of the odds of success. We usually use US stocks for examples, so this time we're looking at the UK market. This is the 5-year price performance for UK listed companies with a market value above £100,000. There are 830 companies divided into 3 groups. Mid and large caps, over £2 billion, small caps, between £250 million and £2 billion, and microcaps, under £250 million. While there were a handful of big winners amongst the small caps and microcaps, there were far more losers. The important takeaway is the number of big losers amongst the microcaps and how it increases as you move from small to micro. When you move into the microcap universe, the odds are really stacked against you. Now let's talk about the advantages of small cap investing. Slightly bigger companies, i.e. those above 300 million or so, can be very lucrative for retail investors. They are too small to move the needle for large funds, and they don't generate enough fee income for analysts. That means they are more likely to be overlooked and mispriced, but it also means you need to do more work to find the information you need. Small caps can offer more growth potential and big returns if they do get big enough to get the attention of fund managers and analysts. Small companies are usually more focused on a single business, which makes it easier to understand them. Now let's talk about small cap growth stocks. Small companies that have the potential to become big companies can generate huge returns for investors. The thing is though, there's plenty of volatility along the way. Most of these types of companies are in tech, media, and consumer sectors, but they of course can be in other sectors too. These companies are often prioritizing growth over profitability, so they might not be profitable just yet. But they should have growing sales, or at the very least, they should have evidence of traction in the market. There should also be evidence of a competitive advantage of sorts because strong sales growth typically attracts competitors. For investors, the biggest challenge here is figuring out how big their addressable market is, how much market share they can capture, and what sort of margin they can earn in the future. Answering those questions will help you determine a reasonable price to pay while still being able to generate a return. For example, London-listed AB Dynamics sells test systems used for driver assistance and autonomous vehicle technology. Its revenue has doubled in the last 3 years, and the company already earns a respectable margin. If you were working out a fair value here, the key factors here would be the potential market size and the competitive environment's impact on its margins. Now let's talk about small cap value and quality stocks. Small companies don't have to be growth machines to deliver excellent long-term returns for shareholders. In fact, companies increasing revenues at modest rates are more likely to be overlooked and trading at attractive valuations. These are often companies that provide niche products and services, and often the less glamorous the industry, the better. The industrial, financial, and healthcare sectors are full of small companies that provide essential goods and services to other industries. The limited market size often means there isn't much competition and there's less pressure on margins. Some of these companies earn annuity revenue, in which case their revenues are fairly stable. But a lot have lumpy revenue streams because they do a small number of big deals each year. Less consistent revenue can be an advantage because it leads to price volatility and more opportunities to invest at an attractive price. For example, Andrew Sykes Group, which sells and installs environmental control equipment, is a good example. Revenue hasn't increased every year, but it has increased gradually over a long period of time, and so has the profit margin, which is now 22%. The company is also able to pay big dividends with its cash flow. You can create a fair value and narrative using the Simply Wall Street narrative tool from any stock on your watchlist or portfolio. Writing your narrative out helps you outline what future state you think the business could reach. As for estimating a fair value, that can help you decide what price to pay if you do want to invest. Narratives are a great way to inform your decision-making processes, whether that's to buy, sell, or continue holding the stock. When creating a fair value on our tool, the key variables you'll need to decide on are revenue growth, future profit margins, and a future PE ratio. Below is an example for Andrew Sykes Group mentioned above. This fair value estimate assumes revenue grows in line with historical trends, which is roughly 3.5% for the next 3 years, and the profit margins and the PE ratio stay flat at around 22% and 13 times earnings respectively. If you happen to believe that's likely to occur, with a discount rate of 7.6%, which you can also change, then you might believe the shares are roughly worth £4.74. Of course, as you change any of those variables up or down, the estimated fair value will change accordingly. You'll notice in this example that there are no analyst growth forecasts. This is often the case for small caps, as very few are covered by analysts at brokerage firms. While that means you have to come up with your own estimates, the lack of coverage also makes it more likely that a company has been overlooked by investors. Now, before we get into the insight here, let's wrap this up with talking about speculative and pre-revenue businesses. At the high end of the risk spectrum are speculative stocks. These are usually classified as penny stocks, microcaps, or nanocaps, but they can be much bigger. As an example, Virgin Galactic managed to reach a market value of $19 billion, although it's currently sitting at $200 million, and shares many of the qualities of speculative penny stocks. These companies typically, 1, have little or no revenue, 2, are often pursuing a goal with massive upside potential but low odds of achieving that goal. Examples include biotechs, energy and resource exploration companies, and companies developing clean energy technologies. And thirdly, they often have a very compelling idea but no real business model yet. This is what the revenue, earnings, and cash flow chart for a company in this part of the market often looks like. Some companies in this space are completely legitimate, and some are outright scams. Many fall somewhere in between the two though. A company can pursue a real goal, but exaggerate the progress they are making to keep raising capital, which then gets paid out as lucrative salaries and bonuses to the executives. The smaller a company is, the more likely its stock is to be the subject of manipulation, pump and dump schemes, and fake publicity campaigns. Working out a realistic valuation for a company like this is also tricky, and it is easy to overestimate the potential and underestimate the risks. Investors are often diluted significantly as the company keeps issuing new stock, and this of course needs to be accounted for in the valuation. Another overlooked risk is that if the company is successful, it will get acquired at a price that doesn't actually compensate investors for the risk they took. If you own a stock that gets acquired at a 100% premium, it might seem like a great return, but you may have needed a much higher return to justify the risk you took. Remember, if the probability of success is 5%, you need a 2,000% return to offset that risk. So, what's the insight with all this? Invest in businesses, not ideas. The small cap universe is full of companies with great ideas, but turning good ideas into profitable businesses is not easy, and you can avoid a lot of losers by looking for real businesses. You can also increase your odds of success by asking the following questions about a company, and particularly those that don't have a proven business model yet. The first question is the executive team enriching itself at the expense of shareholders? If a company is losing money, management salaries should be very modest. If the leadership team is confident about a company's future, they will take most of their pay in shares or options. If they aren't, they'll probably opt for cash. The second question should be, what are the executive team's backgrounds? Value-destroying companies are often run by people with a history of starting similar businesses, often in whatever industry is popular with investors at the time. Legitimate business leaders usually have a track record in one industry. And the third question to ask yourself is, why is this company listed? Being publicly listed is expensive and takes time and effort on a management team. Venture capital funds invest billions in privately held companies when they see potential. If a small company is publicly listed, it may mean it was turned down in the private market. To get some help answering these questions, check out sections 6 and 7 on any company report on Simply Wall Street, which is the management and ownership section. While these are specific questions to ask when we're looking at a particular stock, how do we narrow down our investable universe of stocks to find specific stocks to look at? That's where a screener comes in. Using ours, you can simply and easily add on filters for everything from future growth prospects and proven past performance to dividend yield and management alignment. You can narrow down your investable universe of stocks from tens of thousands to hundreds or even dozens in just a few clicks. Once you're happy with the filters, you can save your screener on your account to be notified of any new stocks that meet your criteria going forward. This can help make the process of discovering new stocks in the small cap space easier and quicker. Now, let's wrap up with the key events during next week. On Tuesday, Canada's year-on-year inflation rate will be published for May and is forecast to fall slightly from 2.7 to 2.6%. On Thursday, the US GDP Q1 growth rate final estimate is expected to be 1.3%, lower growth than what we saw in Q4 of 2023, which came in at 3.4%. US month-on-month durable goods orders growth will be released and is forecast to fall to 0.4% from 0.7%. On Friday, France's year-on-year inflation rate is forecast to tick up to 2.5% from 2.3%. The US core PCE price index is due and is expected to rise slightly to 0.4% year-on-year. Personal income and spending are both expected to rise slightly. The US Chicago PMI index is forecast to rise from 35.4 to 42. Earnings season is all but winding down. However, there are a few big players that are due to report this week, and they include Micron Technology, Nike, Paychex, General Mills, FedEx, Levi Strauss, Carnival Corp, Manchester United, and Anglo Gold Ashanti. That's all for this week's Market Insights. Thank you so much for listening, and until next week, invest well. Simply Wall Street analyst Richard Bowman and Simply Wall Street have no position in any of the companies mentioned. This recording is general in nature. We provide analysis based on historical data and analyst forecasts only, using an unbiased methodology, and our articles are not intended to be financial advice. It does not constitute a recommendation to buy or sell any stock, and does not take into account any of your objectives or your financial situation. We aim to bring you long-term, focused analysis driven by fundamental data. Note that our analysis may not factor in the latest price-sensitive company announcements or qualitative material.